Welcome to the UK Mortgage Market Insights for the week ending Friday, the 22nd of May 2026. There's a lot to get through this week, so let me give you a quick rundown of what we're covering. We've got lender rate changes across the board, with some cutting and some increasing. Swap rates have moved down meaningfully this week, which is good news. On criteria, NatWest have made a big move on loan to income for higher earners. We've got the ONS house price figures out, inflation data that looks good on the surface but has a storm coming, job numbers, and the TMW buy-to-let barometer, which paints a pretty clear picture of where landlord sentiment is right now. A lot going on, so let's get into it. And if you haven't already, do hit subscribe so you don't miss these updates every week. Starting with the rate changes, and it's a bit of a mixed bag this week. NatWest are increasing some of their mortgage rates, which is worth noting given the wider direction of travel. On the flip side, Halifax and Birmingham Midshires have made slight reductions, so they're heading the other way. Nottingham Building Society has gone a bit both ways, with a mix of increases and decreases dependent upon the product. Atom Bank are putting rates up. Santander, though, are making some cuts across new and existing residential and buy-to-let products, which is a more meaningful move given the breadth of it. And TSB are also bringing selected products down. So overall, not a clean sweep in either direction this week. Some lenders tightening, some loosening. What's really worth watching is what's happening with swap rates, because that tells us where rates are potentially heading. And this week, swap rates have moved in a positive direction. At the close on Thursday last week, the 2-year swap was at 4.245 and the 5-year at 4.253. Closing yesterday, the 2-year had dropped to 4.079 and the 5 to 4.217. So the 2-year in particular has moved quite notably in a week, down around 17 basis points. That's a meaningful shift, and if it holds, you'd expect to see lenders potentially following that with rate cuts in the coming weeks. Swap rates are essentially the cost of money to lenders, so when they fall, lenders have more room to price competitively. We're not there yet across the board, but the direction is certainly encouraging. Now, looking at criterion, there are two moves worth covering this week. First, NatWest have increased their maximum loan-to-income ratio where earnings are over £150,000. They are now offering up to 6.5 times income at 75% loan-to-value or below. They've described this as their fourth loan-to-income enhancement this year, and for brokers with higher-earning clients who want to maximize their borrowing, that's genuinely useful flexibility. Second, and going in the other direction, Accord Mortgages have raised their minimum income threshold for anyone looking to borrow above 4.49 times income. In practical terms, that means some people who could previously access higher borrowing levels through Accord now simply cannot. Now, I'll be straight with you on this one because Accord have been getting an awful lot of business over recent weeks, and their service levels have taken a hit as a result. I would assume that they're actually tightening their policy deliberately to reduce volumes and get things back under control. It's a sensible business decision from their side, but it does mean fewer options for some borrowers, and it's worth knowing about before you or your broker approach them. Now, house prices. The ONS have released the latest house price data, and the headline figure is that annual UK house price growth has essentially flatlined. We're looking at no growth in the 12 months to March 2026, down from 1.7 in the year to February. Average prices are sitting at 268,000. England saw a slight fall of 0.6%, while Wales and Scotland were up 2.9 and 1.6% respectively. Now, an important point on this data is it only runs to March, and that was before the Middle East situation really started to bite and uncertainty crept into the market. Things have moved since then, and the expectation is that in the coming months' releases, things will look worse than this one. If you're looking to buy, this is actually useful context. It is still a buyer's market, and you have more negotiating power than you might think, but we'll come back to that in a minute. The ONS have also released the latest inflation figures, and the headline number is 2.8% in the year to April, down from 3.3% in March. That is a half a percentage point drop in a month, which sounds like really good news. And Rachel Reeves certainly thinks so because she's been out there bigging this up quite a bit and taking the credit as usual. But if you follow the economics closely, you'll know that the numbers coming in the next few months are likely to be significantly worse as the impact of global trade disruption and the Middle East situation feeds through into prices. This is the calm before the storm. The Bank of England is going to find itself in a very awkward position. Inflation rising again, but growth weak. They can't aggressively cut to stimulate the economy without risking pushing inflation back up. And they can't hold too long without hurting borrowers and the housing market. Core CPI came in at 2.5%, down from 3.1%, and services inflation dropped from 4.5% to 3.2%, which is actually the more meaningful figure for the bank. But I wouldn't expect them to get carried away with cuts on the back of one good number. Moving on to jobs data, on employment, unemployment has edged up to 5%, though it's down slightly quarter on quarter. The employment rate is at 75%. Vacancies are continuing to fall down to around 705,000, which is the lowest level since 2021. There are now 2.5 unemployed people for every vacancy. The jobs market is softening, which adds to the overall picture of an economy that needs support. But the bank will be watching all of this very carefully alongside the inflation trajectory before they make any moves. Now, the Mortgage Works have published their Q1 2026 buy-to-let barometer, and the figures make interesting reading if you're involved in the landlord space. Confidence amongst landlords has slipped across the board. Confidence in their own lettings business is down from 31% to 27% year on year. Anticipated rental yields have eased from 35 to 31%, and optimism around capital gains has dropped from 18 to 13%, and that's the sharpest fall of the three. Perhaps the most telling figure is this: 42% of landlords are planning to sell at least one property in the next 12 months, compared with just 8% who are looking to expand their portfolios. That's a significant imbalance, and it reflects the cumulative pressure of the last few years. Tax changes, regulation, Renters' Right Act, all of it is adding up. On the finance side, 64% of those planning to buy intend to do so through a limited company structure, which has been the consistent trend for a while now. And 39% of leveraged landlords are planning to remortgage or take a product transfer in the next 12 months, which is a significant chunk of business for brokers. Rents are still going up, with 65% of landlords having raised rents in the past year, though that is down 5 percentage points year on year, so the pace is easing slightly. The picture overall is a sector under pressure, with more sellers than buyers among existing landlords. That has implications for rental stock and tenants further down the line, and it is something that policymakers really should be paying attention to. So what does all of this mean if you're sitting there with a mortgage thinking about buying, or you're a landlord trying to figure out your next move? Well, swap rates falling this week is genuinely encouraging. If that direction holds, we should see more lenders cutting rates in the coming week or two. Don't panic if your deal is coming up. Speak to a broker, understand your options, and don't just accept whatever your current lender puts in front of you. On house prices, yes, the growth has stalled, and yes, it may get bumpier in the months ahead. But that is genuinely good news if you're looking to buy. Sellers know the market has cooled, and that gives buyers leverage that they haven't had for a while. It is a buyer's market right now, so use that to your advantage. My view on the Bank of England hasn't changed. I think that at the next meeting they're going to hold at 3.75% in the near term. The inflation drop this month is welcome, but the supply side pressures coming from global disruption aren't going away quickly, and cutting into that would be a mistake. They'll want more evidence before they make any more moves. Who benefits most right now? Well, first-time buyers and anyone looking to purchase. You have negotiating power on price. You have more mortgage products available than you might think, and if you've been sitting on the fence waiting for rates to drop, the direction of travel is your friend. Get proper advice, understand your position, and move when you're ready. Well, that's it for this week. Quite a lot going on as usual, so thank you for watching, and if you found this useful, please do subscribe. It really does help the channel. I'll see you next week, so until then, take care.